go, sir.
All right. Good morning, everybody. We're going to get started. This is the open question and answer session related specifically to kind of grants management issues and also cost accounting. My name is Ben Schrag. I'm the Senior Program Director here in the Small Business Programs, and I have some colleagues with me here on the podium, and also other colleagues who I'm welcoming to join in, who are here in the front row from two of our offices at NSF, the Cost Accounting and Pre-Award Branch, which we call CAP, and the Division of Grants and Agreements, which we call DGA. DGA are the folks who actually sent you your Phase I award. You should at least have heard from them at least once. And the folks in CAP will be involved in, if you're recommended for a Phase II award, in actually evaluating whether you are in a position where we can give you that quantity of government funds to make sure that you can track those funds and spend them responsibly. So I'm going to introduce my colleagues real quick. I don't know if I can do justice, but May, Sohail, Charlie, do you want to introduce yourselves? May, you want to go first?
Thank you. Good morning, everybody. My name is Willie Mae Powell. I am the team leader for Engineering IIP in the Division of Grants and Agreements. I am the individual that you've probably seen my name on the bottom of your Phase I awardee notice. It says Willie Mae Powell. That's me. I am also the one that you will see if you are lucky enough to get a Phase II. You will see my name at the bottom of your award notice. I do get a lot of emails from different people from the some of the grantees, and DGA is here to help and do whatever we can to help you. So if you have a question when you do get your award notice, please don't hesitate to contact us. We'd rather help you earlier than later. And I'm going to pass this on to our people in CAP.
Okay, I got it.
Oh.
Hello, my name is Sohail Ahmed. I'm a lead analyst at CAP branch, which is Cost Analysis and Pre-Award branch. And we actually do the review of the proposal that the prospective awardee submits to NSF.
My name is Charlie Ziegler. I'm the branch chief for the CAP branch. I've been with the National Science Foundation for over 30 years. I've been involved with the SBIR program when it was a cost reimbursement program, through the changes all the way to this quasi-fixed price arrangement we have. And just to kind of kick it off and get you thinking about things, there are three major components to the cost analysis review. One is the financial viability of an organization as to whether there would be an elevated risk that they might have to use NSF grant funds to pay normal operating costs. This is what I would call a go, no-go criteria. So it's viewed very seriously, and it's probably our major reason for declining to make an award for other than technical reasons, which the program office would make. The second component of our review is accounting system review. This program-wide is generally viewed as a fixed price grant. It does have a reversionary interest, a reporting requirement, 6-month reporting requirement on incurred costs, and an end-of-period reporting requirement on incurred costs and level of effort. So the accounting system review basically focuses on, does the organization have a project cost ledger, and can they track costs by individual activity or grant in this case? And do you have a method to track time of your personnel? The third major component of our review is what we call a budget review. Since this is going out as a fixed price grant, the scope is determined by the program officers and what is necessary to accomplish the research, but we then have to price that to give the grants officer, May Powell, and her group basis to say this is the amount that for which we should make this award. So that would be my kind of introduction. This is intended to be an open mic question and answer session where you can come to us with your questions, and we will attempt to provide you our best advice.
And so floor is open, but let me just say, as folks think about questions, in case it wasn't obvious for folks who came in late, we are all on camera. You're probably not on camera, but your voice is going to be on camera. So please use the microphone. If not, we'll repeat the question, but we just prefer that you come up here and use the microphone, and stick around until we've kind of finished with your question in case you have follow-ups.
Hi. So this actually comes from my CPA accountant, so excuse me if I read it to you. So we're currently an LLC partnership. That's the form of company we have. And he asks if, so he says that according to GAAP, we can't be paid salaries, we should be paid through guaranteed payments. And he asks if that is acceptable on the grant as defining them as guaranteed payments rather than, quote, salary.
I would caution all the audience members who are coming into the Phase 2 with an LLC type structure. I recognize that it's easy to incorporate, $79 in filing fees on LegalZoom, but it is also an issue if you have to issue stock, because you have ownership controlling interest concerns. It can be an issue on payment. Was your CPA is right. Normally an LLC owner is paid by the profit of the organization, but there is also this guaranteed payment mechanism for bona fide work performed for when you're actually an employee that you can receive a payment. I would recommend that. The third issue we see sometimes with LLCs is if they make a draw and they're on a cash basis, that may need to be reported in that tax period. So that has caused some issues. So those would be my three things, and I would advise you strongly to consider before you go into the Phase 2 if that's going to be the optimal structure organizationally. And do that prior to applying for the Phase 2, because there also has concerns as to the legal entity we're making the award to as a different type of corporate structure, which can also make an additional review necessary. So that would be my concerns with the LLC structure. I understand it's very attractive for a small organization initially to get off the ground, but I think by Phase 2, you may want to consider if that's going to be optimal.
Okay. Thank you very much.
So my questions are very similar to that, is right along the same LLC lines. My accountant said, well, as a single-member LLC, you can't be on the payroll, you got to take draws against shareholder equity. And so, especially with regard to the review of Phase 1, when I'm going through the CAP review for Phase 2, if you guys see shareholder draws as opposed to a payroll expense for my level of effort on the Phase 1, is that a problem, or will you be able to recognize that, oh yes, what would have been an expense was actually a shareholder draw here?
It can be a concern because the FAR, Federal Acquisition Regulations Part 31, which is the cost principles for for-profit organizations, specifically states for solely closely held corporations, profit can't be treated as compensation. So that can raise issues. I would definitely recommend you talk with your CPA, and I understand LLCs are governed by state law, so there can be some variance depending on what state you're in as to can you have a guaranteed payment rather than a draw against the potential profit.
Okay. And a follow-on question to that. So if I am submitting my financial statements, and since there's no audit, I would be also submitting tax returns. Since it's a pass-through entity, that means I would be submitting my personal tax returns, I assume. Do you want to see all of that personal stuff in there, or can I redact information like my children's name and social security number that?
I think you can totally redact any personal or privileged information. Actually, I would prefer that we not even see that type of stuff, social security or names or addresses.
Do you need to see the whole tax return, or just like the Schedule C for that, for the entity?
I think that we would want to see in order to judge your financial viability, we would prefer to see audited financial statements, or at least a compilation of the entity that we're talking about. I think that your personal tax returns are not really something that I want to see, but I also understand that LLC income can be reported on personal and tax returns.
It is in my case because it's a pass-through entity.
I don't want to pretend that I'm any type of IRS expert, but yes, I understand that can happen. I would recommend that you look to even consider, is an LLC going to be the appropriate mechanism for your organization going forward?
But that isn't really my question, because it doesn't matter, the LLC already exists and is doing the Phase I work. I cannot change that now. I could change it for Phase II. I totally understand the very good rationale for moving away from an LLC for Phase II. I'm talking about when you guys are reviewing the work done in Phase I, and the entity there was an LLC. You're going to look at financial statements, which are unaudited, and thus you're also going to look at the tax returns, which in this case would be my personal tax returns, because it's a pass-through entity.
I would prefer not to see your personal tax returns myself. So I think in this case, I think you should opt with just providing the financial statements unaudited.
Okay.
I understand the instructions, but I don't think your personal tax returns are
Okay.
something that I want to
Well,
review.
and that's
Do you
fine.
have a
I would
difference of opinion?
really rather not share that, but the instructions state that you gotta, if they're not audited, you gotta send in
I
a,
understand.
LLC has a 1065 you have to file in, right?
I'm sorry?
Is that the form, different form for LLC partnership or?
A single
and
member
then you-
LLC, I just put on a Schedule C as
You
far
get
as
the
I know.
K1 from there. And then that gets reported to your personal tax return.
Yeah, I don't know, this is my first year going through this, so I'll
So,
go back to
yeah.
my accountant and ask him about
Y-
that
y-
stuff.
Your organization information would be in 1065, Schedule K and all
Mhm.
that. So you
But
can
I don't
submit
think
that
I
one.
submit a Schedule K as a single member LLC. I don't think I have a form, that form. I think it's all just a Schedule C.
Schedule C should be good, yeah.
Okay.
Yeah.
Okay, thank you.
Hi, thank you guys for being here. So I know there aren't any official guidelines on this, but we were told by our program officer, when you're looking at financial viability of a company, you're looking to see, do they have enough cash burn at their normal rate for roughly 4 to 6 month kind of timeline? And I was wondering if you could maybe just provide sort of an example of that, of what you're looking for in that, because, as small startups, there's a lot of fluctuations. Usually it's only a few employees, and we can go without pay for certain stretches, or, there's just a lot of fluctuation month to month in terms of what we're spending. If you could maybe just speak to that point.
Certainly, there's two types of what we call burn rates. One would be the gross burn rate, which is be simply dividing your total expenses for a given period by the number of months. So you could say you spent $120,000 over a 12-month period, that's $10,000 a month. The other one we sometimes use is a net burn rate, which would be to take your operating losses and divide that by the number of months. So those would be the two burn rate calculations that are frequently used. And our expectation is generally around 6 months that you would be able to operate, primarily because there can be gaps in the funding that's provided by NSF in between Phase I and Phase II. In addition, we withhold roughly 15%, I believe, for the final payment. And that's $100 and some thousand. So your organization, if they has to do the work and front that money before they're submitting the final report to pay their employees, you're going to have some cash on hand. Also, a lot of businesses, small businesses, fail if they don't, in the first 6 months, if they're not ready to manage that kind of funds. I'm a bit skeptical of organizations that turn off the faucet, to be absolutely straightforward with all of you. You're setting up a business, going in as an entrepreneur. It's not like a soft money science position in academia where you don't got a grant, you don't work. So that organization is going to look less, you might think it's a good thing saying, hey, I won't pay my people, or we won't work, we don't have a grant. But I would view that as you're less financially viable as a small business, if that makes any sense.
Yes, it does. Thank you. So would that be judged, I guess, at the time of your review? So say it's usually 3 to 4 months after a submission date? So that's, at that point, that would be sort of the snapshot you get of
I
the
think we
company's-
tend to, most of the organizations, particularly at this time of year, are submitting interim financial statements for the partial period up to June or May, whenever they submitted their data. So we typically would take the last complete fiscal year, because certain expenses might be annual, such as insurance, or there's certain types of expenses that your organization incurs, and the partial period, which is, I don't know, 5, 6 months, and then usually run the calculation off of that. If there's a lot of variance, we might add another year in, depending on how long the organization's been in business.
Okay.
Other thing we're going to look for is profit. Does the organization have losses? Understanding that early startup R&D can just have losses, but looks much better if you have some sales or some consulting income or some outside sources. Is your revenue solely the NSF grant? Do you have other grants or other awards, other people interested in your idea, maybe a state seed funding? Do you have loans, or is there a lot of debt? I mean, the nice thing about a startup organization is you probably haven't had the time to incur a lot of debt. If you do have debt, to who is it owed? Is it on a credit card where they're going to give you a demand payment each month or jack up your interest rate? Or is it owed to the principals? I.e., you brought up the example of not taking salary. Well, you could feasibly defer that income or have a note payable from the company to show that sweat equity and ensure it gets paid off in the future. That's going to be viewed as a less liability than my standard debt instrument. So in that case, we might ask, is the holder of the debt going to call it due? Another type of, what I'm talking about debt, would be convertible notes or safe notes, where they're going to potentially convert to equity. Would you potentially be able to obtain commitment letters from potential investors to state that I'll provide $200,000 at a date certain or at a milestone event to help this company with its perceived cash flow? But yes, I would emphasize that financial viability is probably the biggest single reason that we would recommend to May and her group a declination for these Phase 2 awards. I mean, it's $750,000. That's about 90 taxpayers at $8,000 a pop that are funding this particular activity, and that's a pretty serious concern for us as stewards of federal funds.
So you mentioned the letter of support from an investor. So how would you take that into account in calculating sort of what's on the book? I mean, is that actually considered as part of what will be on the books within the next 6 months?
Yeah, you're dead right. It would not appear in your financial statements, and we would account for that separately when we'd say, on the face of it, they've got looks questionable financially, but we consider that there's this $200,000 investment from coming in, or $70,000 grant from some state seed fund organization, or they're in negotiations with a bus company to install this transit device that detects red lights, and the state is interested in funding this out at so many dollars a bus.
Yeah, essentially a letter of support. in that
Letters
manner
of
can help.
support, letters of commitment, those are good things to have. And like I say, debt owed to the owner, I doubt that you as the owner are going to call your company debt due in the middle of Phase 2 and shut down the operation.
Right. Certainly. Sorry, I'm not going to hog the mic, but I do have one more question about the time and the level of detail that you expect in the accounting aspect of things.
I expect that you're going to have what I call a project cost accounting system, and that means that you're going to have set up a separate account code for each of the different direct cost activities, which would be the grant. Maybe you do some outside consulting, maybe you get an NIH grant. So each of those is going to have a separate account code. Under that account code, you'd have your various expenses: salaries, wages, fringe, travel, material supplies, whatever is in your chart of accounts that you're using for expense codes. That should align or be able to be aligned with the NSF budget line items. So you can track with your system back to my NSF budget. Your project cost ledger, which would be the output from a project cost accounting system, should be able to print that out, and that should compare budget to actual and have amount remaining. So I would expect those three fields. Most systems will also have a field that could show commitments, where I've got a subcontractor, I've made a purchase order, the expense hasn't hit my books, but I have these funds obligated. So those would be kind of the four columns I would expect across the top, and then the rows going down the side would be my different expense line items. So I'd expect that you have a capability to generate something like that. As I mentioned, you're going to be required to report on expenses periodically over the term of the award and actuals at the end of the award, according to the award terms and conditions. The second thing I think is critical importance would be that you have a time and effort reporting system, that you have some means to capture the level of effort. Fixed price arrangement, the level of effort has to still be there regardless of actual expenditures. So we're going to want you to be able to track time. That could be by hour, it could be by percentage, it could be by 2 weeks, or I would recommend that that coincides with when you make payroll, so that you can tie your payroll system over to the actual effort incurred. The third thing that we could look at would be internal controls and segregation of duties. Do you have more than one individual involved in the transactions? Those would be kind of the three areas we would primarily look at. Although the SBIR award terms and conditions do incorporate the uniform guidance to CFR 200, we don't generally require that you have all those systems in place during our review. I mean, so
Yeah.
I've hit the big three ones that we would feel are totally critical to this particular effort as far as accounting system goes.
Okay, thank you. Sorry, another question. But it states that we can spend money up to 90 days prior to an award date. And we did incur some expenses 90 days prior to our award date. I was wondering if there's any like scrutiny with that, like special scrutiny.
You want to?
I will take this one. So, again, I'm Willie Mae. The only thing I would caution for you and your company is if you do pre-award spending for your phase two, if you happen to get a decline, it's at your own risk, and
Right.
that means your company's gonna have to eat that cost. So just be very careful of spending prior to getting a notification that you're actually being recommended for funding. So there is some risk, but it's at the awardees, it's at your level, okay?
Okay.
We don't typically review or pull invoices or transaction testing on any pre-award costs. We could and do sometimes ask organizations if we have concerns about their accounting system, their project cost ledger, or time and effort reporting system, of what did you do under phase one? I mean, I think a very fair question is that I could ask is, send me your project cost ledger that you used for your phase one award.
Okay. Thank you. Appreciate it.
Hi. So I'd like to drill down on the project cost discussion that was just had. So we use QuickBooks, and currently, we also have timesheets. And currently, our timesheets do not reflect the time, in QuickBooks, the amount of time that our employees are spending on the grant. So you need to go outside of the QuickBooks project ledger to get the information on the amount of time spent on the grant. Is that sufficient, or does it all need to be within the QuickBooks system, for example?
I can't recommend any one vendor. As a federal employee, it's illegal, I think, for me to recommend any one vendor over another vendor, so I won't make statements about a particular company, but I can talk about the capabilities of the system. And I would look to have more of an automated system that tied to that rather than having to go out to separate spreadsheets that link. The Phase 1 award does provide, I believe, up to $10,000 in funding for the organization to engage CPA to do accounting system setup, purchase accounting system, or even financial viability, so you know what you're looking when you come into phase two. And you may want to look at that capability enhancement to your system to have that automated. We take I don't know, dim view of the Excel spreadsheet type. To me, that really isn't an accounting system. And it's manual, prone to errors. There's any number of concerns that can be raised with a spreadsheet system, or the need to go outside your own accounting system with additional records or documentation.
Okay, very helpful. If anybody in the audience has experience with Paychecks or QuickBooks and how to connect the two, I'd love to connect with them. Thanks.
Hello. So I have a couple questions, and I'm going to start with, is the funding, the award funding taxable? Taxable. Is the STTR or SBIR award taxable?
Taxable?
Yeah.
The income that you pay people is going to be taxable, and your company itself could have to pay taxes too.
You mean like so basically do we need to pay tax on the grant amount? And how we, it's revenue, right?
The revenue, the profit, yeah.
Yeah.
If the company makes money, you would have to pay tax.
No, not, I mean, like, is the award, like, award, is that taxable? It's not revenue, it's just from NSF, the money, is that taxable?
Well, you're going to have revenue, the award would be classified as revenue.
Okay.
Then you're going to have expenses operating under the award, which hopefully, or ideally in my case, is going to pretty much match what we gave you, other than the 7% profit that you would keep. But
Yeah.
you might also have income as an individual when you receive payroll, which would also be taxable.
Okay, and so say we're a C Corp, so we need to report quarterly, and then, so we have all the fund, so we draw $200,000 into our account from ACM, is that the system?
ACM, yes.
Yeah, ACM, and then how would that, does that matter, or we should draw like different amount for like every year, because we need to report on tax? You look very confused.
Under the phase one, you draw down the first 200,000, I believe, and then the remaining 25 is kept out to the final project report. Depending on your corporate structure, and I've seen issues with this, that, and when the draw occurred, if you're cash or accrual basis, that you may need to report that, and that can, with certain corporate structures, LLCs, and I'm not certain about C Corp, but sometimes we've seen situations where they may say, their accountants may provide them advice that that needs to be reported as profit. So that's not an unusual situation. I would be very careful with that, and that's additional reason why I advise a more robust incorporated structure rather than the more simplified ownership arrangements.
Okay, so if you pay tax, is that something you can put in as indirect? Have to pay tax on the grant we just got, and then there's something, anybody had this problem? No.
I don't believe under the federal acquisition regulations that tax is considered an allowable expense.
Okay, so like any tax we pay for, say, like payroll tax we have to pay as a company cannot go into the indirect or anything like that?
That
Could-
is the different issue. There's two different issues.
issue. Okay.
Payroll tax, yes, those are expenses.
Okay.
Those are part of your fringe benefits.
That's indirect.
That is indirect, yes.
Okay.
Could be part of the indirect, but the other portion is not
Okay.
allowable cost.
So can I just make a couple things clear? And it's clear to me that we need to do a better job messaging how ACMS works. Couple of things. First of all, this is probably too late for some of you, and I apologize for that, but $200,000 is available in ACMS to you when your award started, or not quite, something around 200,000. Everything but 25K of your award was available to you when the grant started. there is no reason necessarily you can't draw that down any way you would from a normal bank account, except you can't put it back, right? So you should view ACMS as a one-way bank account, right? It's not a bank account in the sense that if it's in ACMS, your accountant doesn't care about it until you take it down from ACMS, is my understanding. Unless they draw funds down from ACMS, there's no impact on the company's financials, right? The company's financials don't view any of our grant funds until they draw it down, right? That's my understanding.
Yes.
Is that right? So those of you who have drawn down all 200,000, the first 200,000, and anticipate having some of that left when your tax year ends, presumably, which would be December 31st for most of you, then there is this potential issue I think you're getting at that accountants will tell you that whatever is left, if you've spent that money, if you finish your project by December 31st, my understanding when I was an awardee and from working with my companies is that there's no profit, right? There's a 7% profit, but all the money you spent doing R&D, you're not taxed on that because you've offset the revenue from your grant with expenses spent on working on the grant, except for that 7%, which again, you may or may not have spent, you'd have to worry about that, but that's relatively small. But for those of you who haven't drawn down the 200K, just be aware of this, that there are implications. Obviously, you need to cover your cash flow, so you need to draw down as much as you need, but I don't think there's any other advantage to drawing down more than you need. And other than coming up for the next 10 days starting on Friday, ASMS is always open, so you could always access it. It is closed for, and I think you should have gotten an email about this, it is closed for about 10 days starting on Friday because the government's fiscal year is ending. But after that, starting in early October, it's then again available for you to access. And so we're going to actually make it clear in ACMS, specifically for SBIR awardees, how this works. But I just wanted to clarify how it works.
And final question, like, can travel become, like, other than coming to this boot camp, count as indirect expense, or that's not really?
Depend entirely on the purpose of the travel. The SBIR program is a little more restrictive than standard NSF grant programs on travel. They do authorize the boot camp and the travel to this conference.
Correct.
I believe any other travel you need to clear with that program officer, and it has to be directly related to the grant that you would charge.
Okay.
As far as if you were to attend a conference or do something that was for the general benefit of your organization, that travel amount could be classified as an indirect cost.
Okay.
Yeah, and just to reiterate, and again, I shouldn't be weighing in here, but my understanding is that the grant, this workshop and the boot camp, those are direct costs because those are things that you're doing because you have this award. They're doing it as a direct result of this award. And
So
again,
the boot camp is direct?
Boot camp is direct because it's
Direct,
specific
okay.
to this project, unless, you could be doing customer discovery broadly as a company that's not related to this project, and those costs, I guess theoretically, would be indirect costs, but we allow you to use the funds from our award as a direct cost because we're telling you to do boot camp.
Okay, got it.
As far as indirect costs, just remember the general definition is that these are things your organization needs to do its business, but that are not directly a result or related to this specific project,
Okay.
right? And so there could be travel for that, but in my experience, there's not a huge amount of travel your organization has to do to be a business because we don't allow as an indirect cost business development. So that would be the one reason you'd be doing a lot of indirect travel. But just remember that we don't allow, other than the boot camp, we don't allow sales, marketing, or business development as either a direct or indirect cost. Again, other than those exceptions we talked about. Sorry.
All right, thank you.
Sure.
My question is about salaries and how time is split. So for this SBIR, I have about an 80% commitment for the research performed here, and so the rest, the other 20% are coming from profits that we're paying these salaries. How do I report this best? So how we have this set up is payroll usually goes out as one chunk to each person. But if it's split up, let's say 80-20 between the SBIR and the other 20% are coming from something else, how do I report best on that?
Record or report?
Report.
To whom? When?
You guys. So I mean, I keep track of this, but
I would expect to pull, let's say you have a 2-week biweekly pay period.
Yep.
I would expect to pull your time effort report document for that particular period, and when I looked at that, it would say 80% on NSF grant IIP, add 7 digits, and 20% to indirect or consulting or whatever other account code you were putting that time to.
But from the payroll side, so usually I don't want to do 2 payrolls, one payroll for the NSF and one payroll for the for the remainder. Do you guys recommend just doing one payroll and just being clear from the time side how this is split up, or?
Yeah, I think you would have general ledger entries that would match the split. So I'd have
Okay.
one paycheck from your payroll company for the $5,000 a month that person got. Then within my records, it would show that 4,000 of that was charged to the NSF grant and 1,000 of that was charged to some other project code.
Okay. All right, that makes sense. And then following up on this is, so NSF is capping payroll depending on location and whatever it is, salaries, whatever by location or position. Salary components that are not paid from the SBIR, is there a cap on that too, or we can pay employees whatever we want on that side?
You could, if it's from another source, you can pay it however you
Okay.
want. But our budget review for organizations that don't have a revenue stream to show that they can pay that payroll, and for entities that don't have a payroll history of paying the PI or the individuals to be hired positions, in order to determine that that amount is reasonable, when I'm giving my advice to my grants officer over here, and she's going to make the award,
Yeah.
we utilize the Bureau of Labor Statistics, BLS, standard occupational classification codes to determine an amount that we believe is reasonable for purposes of pricing the grant award.
Okay. All right. Good, thank you.
Yeah, my question was essentially what he asked.
Good morning. A couple quick questions. One is on, in the grant requirement, the PI has to work 50% or 51%. Is that on the time span of the grant? Or are you looking at an individual week? Do I care if I work 20 hours this week, right?
Be over the time
Over the
frame
whole-
of the award period.
That I work.
Not saying that every single week you have to do 51%. So you might do 10% one week because you got outside consulting work that you want to make a nice profit on. And then the next week, but over the time frame of that award, your primary employment has to be that 51%.
So let me be clear, there's actually 2 requirements here that are a little bit similar and so are confusing. You're never required to commit 51% of your time to our grant. No one is. That's not a requirement. You're required to commit a majority of your time to the company activities. And so you are required as a PI to commit a certain amount, but it's a much lower amount. Typically it's 1 month out of 6 months, right? So when we did your phase 1 budget review, if you have a 12-month project, we would have looked to see to make sure the PI is committing at least 2 months across that 12 months to our project. But the primary employment requirement, which is congressional-wide, is that during the period of the grant that the PI is 51% with the company, which is to say all the things you're doing for the company on that timesheet that have different classifications of, I'm doing sales and marketing, or I'm doing, I'm hiring people. All those things have to be at least 51% of your professional time, right? And so your timesheet would have to have, across all those activities, 20.4 hours per week, roughly. I guess that's the amount. Across the whole, averaged across the whole award, if that makes sense.
Yep, perfect. And you made a comment earlier about you don't like spreadsheets. So today we do payroll by spreadsheet and then take the granular data and enter it into QuickBooks. So that within QuickBooks, it will say how much is on SBIR versus other activities, but we don't have we start with a spreadsheet basis of how we're tracking that data. Is that problematic?
It's an acceptable document as long as you have supporting documents, that when you're running the report, you have that supporting documents attached to it. Says this is the source coming in, and being able to support those datas.
Gotcha.
Yeah.
Okay, thank you.
He's all right, but I would probably want them to do something better in the future.
Morning. So I want to drill down further into a couple of questions about the payroll. So we use QuickBooks to do all our accounting. We also use a separate HR company called Zenefits to administer payroll and health benefits and everything else. We import the data after every payroll period, and it automatically does all that, but it does it on an aggregate basis. We have 8 employees, of which 4 people are on this grant, on the phase 1. So not all of them are on the grant, and not all of them are 100%, obviously. So they have chunks of time that they allocate to the NSF project. They provide a timesheet, which is on paper or electronic. And when we import the data, it all comes in as an aggregate, though. We have to physically go in and, like you said, allocate it appropriately based on the timesheet that we get from each employee as to what that payroll period, what portion of that was allocated to the NSF project, what portion of it was not. But I was a little bit nervous when you said you take a dim view of someone who doesn't have everything inside of the QuickBooks system, because if you pull up our payroll records, you will see the split, but you won't see which employee spent how much time, because we are input the end result of that, not necessarily which employee spent which time. Does that make sense as a question? So I was a little nervous when you said you take a dim
I understand
view.
your question, and I think you're probably technically within compliance by having this outside system that you can trace where your payroll went to. But my advice is that this could be adequate for now, but you may want to look into a little more robust
Yeah.
accounting capabilities in a system where that is all done internally.
Fair enough. And
There isn't a need to go out to this outside.
fair enough. You're absolutely right. We could do it all through QuickBooks and do payroll through QuickBooks and everything else. But in our analysis, it just showed that it was economically much more viable for us as a startup to go through this separate system, only because QuickBooks is so much more expensive and they don't do everything. So the other question, I know you can't recommend any particular vendor, but my point really is that if we now were to switch payroll providers, that would be very disruptive as well. And so I'm trying to make this distinction between, okay, we can get past phase 1, but does that get us into trouble if we do get a phase 2? And should we start planning for that in case we do get a phase 2?
Do you want,
I have a question. So in your current
Christie?
I'm sorry. Sorry, I forgot the microphone. In your current system,
Yeah.
if I look at and I see somebody's salary 60% charged to the grant, you have backup supporting documents that show why 60% was charged to the grant. You have a timesheet, you have something. It's just the download, the interface from your payroll system to your general ledger system doesn't bring all that data over, but you have supporting documentation to show why you charge 60% to the grant, correct?
Yes, with a small caveat. For example, let's say one payroll period is $30,000, of which we will only say that 2,800 of it went to NSF. It won't say which employee spent which time, but we have that backup.
But you have the backup to show
Yes.
why that entry was made to the grant.
Yes.
And on the timesheets, you have adequate controls where
Yes.
people have signed and they've been approved.
Yes. Absolutely.
I think you're currently in compliance, but, the end result of a SBIR grant, hopefully, cross my fingers, is you have a commercial product that you make sales, you begin to hire people, and that boosts the economy and our whole knowledge.
Absolutely.
So I would think you might want to be forward-looking to have an integrated system that automatically merges.
And your point is very well taken. It's just that we felt that until we get to a point where we've got some true viability of the company, we don't want to make that switch to a much more expensive, fully integrated system.
Just to add, your feed could be granular too. In other words, from the outside system, it could be fed into QuickBooks at a granular level, at the individual level.
We have tried, but they don't support that right now. This is a company called Zenefits. I don't know if you're familiar with them.
Okay.
But they do everything online, and it's much more economically viable as a startup.
Could they give you reports, and then you use the reports?
Yes, they can give us reports, absolutely.
And you use the reports to do journal entries into
Absolutely,
QuickBooks?
we can, and that's what we would be doing. But it's a paper translation. It's not that you can click on one line item in QuickBooks and say, let me go in and find out each particular employee where his timesheet was, and you cannot do that part.
Okay.
But
So the timesheet splits, you're doing manually, right?
yes, yes,
See, that is subject to error, the human error.
and we understand that.
So as you grow, that is something.
It's not
should be in your
scalable.
mind.
We understand it's not
Yeah.
scalable.
To get-
We just
get-
want to wait a little longer until we show that we're
Totally
viable before
understand.
we translate.
Yes.
Thank you.
Hi, this is so valuable. Thank you so much. So we are slow in getting our accounting systems set up. So we're closing in on finalizing that. But there are lots of things to clean up, and one of them is timesheets. So do you have recommendation for how we handle timesheets that have not been created yet? Is there anything we can do? Is that just going to be a red flag?
So, get it set up, but I would talk to your program director, and I think just need to understand where you're coming from. Many of you are in a case where you're just realizing the level of diligence needed now.
Mhm.
We've had companies in that case, and we tend to be able to work with them and making sure that as long as going forward you get this going by the time you submit phase 2, I think
Right.
it can work out. But I would email your program director, because that's
Right.
you need a paper trail, and you need to also potentially get advice from these guys.
We asked him about
Yeah.
that, and he said to ask you.
Okay, ask me.
Yes.
So when I said program director, actually, just call me.
Okay,
Contact
so
me.
I would,
Okay.
I would just provide my own caution, because I've been with NSF for a number of years. We do work closely with our Office of Inspector General. Any documents you create now,
Uh-huh.
be very clear that
Right.
you're labeling these, that they weren't contemporaneous at the
Okay.
time. That
And-
this was, we went back, we
Right.
didn't have this
Yeah.
Okay.
timesheet. We estimated our effort based on our lab notes or our daytimer or our
Right.
So yeah,
calendar.
this is the reason I need you to email me. I'll loop in your program director, and this is my contact.
Okay.
For any of you, I'll leave my business cards here. But as we talked about yesterday, once we tell you to do something, you've got forgiveness from on high. At least we can get in trouble, but to some extent you're covered. You still
Okay.
can't be fraudulent, but
Right.
the idea is if you're doing something and you didn't know you couldn't do it, if you let us know and we say you're allowed to do it, then you kind of have that covered. So before you
Okay.
create anything new, since you're in a place where you can't ever have the source documents because you
Right.
can't turn back time.
Right.
Take the time and we'll talk about it and we'll get some guidance. We'll make sure that you do it in the right way.
Okay, perfect.
That's true
Thank
for
you very
anybody
much.
here in the room if you want to contact me about this, because this happens occasionally. Like I said, lots of companies have been in this place and we figure out a way forward.
Thank you.
Good morning. Sorry I was at the other one-on-one meetings, so this may have already been asked, but transitioning from phase 1 to phase 2, we talked to the program directors a bit about having money in the bank and having, burn rate and how much money and additional investments outside of NSF. What amount are you looking at? Do you look at somebody has a burn rate for 4 or 5 months? Do you look at certain investments to say this company is actually economically viable and is going to be able to move through the phase 2? What criteria do you look at for that?
We look at all those things. And I think I did answer it, but I'll be happy to go again,
apologize.
because I understand that people are doing their one-on-ones during this same time frame with their program officers. But financial viability is one of the most significant concerns during our review, and is the major reason that we recommend declinations to the Division of Grants and Agreements for administrative purposes, not the technical declinations. I believe those are more. But yes, we would look at cash on hand.
Okay.
How much cash do you have? We'd look at short-term liquidity, current assets versus current liabilities. We would look at a burn rate, which could be a gross burn rate, total expenses for a given year divided by 12, or a net burn rate, which would be my losses over that period divided by the number of months covered.
Okay.
We'd look at that generally for the last complete year and the interim period, because you may have interim financial statements for the years not completed. We do these kind of off-cycle, off the standard calendar year cycle. We would look to see if you did have liabilities, what type of liabilities those were. Were they payable to a principal or an owner who isn't going to call it due and crash the company? Are they convertible to equity, such as convertible notes or safe notes type things? So we would look at that very carefully, but yes, we really want to ensure that there's a low degree of risk that the SBIR company will need to use federal grant monies to pay normal operating expenses.
Okay, very good. One quick one related to that. So a lot of companies, when you're developing these, the founders put quite a bit of cash into the company. A lot of companies set up to where there's a promissory note to the founder, but it won't be paid out until there's like an exit. You know, they're not using any investment money to do that, but it's a way the accountants figure out how much was put in. Is that a negative when you go through those because it's actually a debt?
It would
but
be
it's
classified as a liability, but we would ask questions about what type of that liability is, and would the debt holder or the note holder sign a statement that they won't call it due? Do you potentially have other angel investors that might sign a commitment letter if you're short on cash? We also look at, is the company profitable or not? And quite honestly, a good portion of these small startups are not profitable yet.
Right.
How much equity remains, or are they in a big negative equity type position because they have burnt through this kind of sweat equity type thing? But those are all considerations we have, so it's really quite difficult to give you a single number. But I would say if you have $5,000 in cash in hand and you have a quick ratio less than 1 and you're losing money and you've got a bunch of liabilities that are due or payable, you wouldn't be in real good shape.
Okay, yeah, that makes sense.
Sorry, can I just add on, correct me if I'm wrong, gentlemen, but in the situation hypothetical, that you stated, where you said basically you have no intention of calling in these liabilities, calling in these debts until an exit. First of all, I understand there's a way to account for that, but I suspect there's other ways to actually, that sounds like an equity, that sounds like sweat equity to me. I understand, I think there's other ways to think about seniority for assets and things like that, but obviously I think my understanding is that a letter from those folks saying basically they have no intention to actually call the loan is something that's relevant as well, right?
Yes, sir.
Yes. Okay, so I
Yes,
think
sir,
that's
definitely.
that's important, because again, you have to make sure you convey, there's a lot of different types of debt on the balance sheet. They can look similar, but a bank isn't going to give a, you know what?
Right.
If company has got a great exit on the horizon, they just want their money on a certain term. Whereas, angel investors understand, or convertible debt obviously is very different. Your convertible debt investors, it's not in the terms of the agreement, but they know there's two things that can happen. They get equity or they lose their money, right, basically. But obviously, you have to make sure that they can convey the nature of that debt, because, looking at the financials, it's not always clear what kind of investment or what kind of note holders you have in your company. So I think getting clarification from people who hold the debt is really important. Even if you can't get a certain investment committed, making sure you get those letters is something I would also line up in preparation if you have debt on your books.
And that's the same thing for the convertible notes. A lot of angels like to do the convertible notes to debt.
Yeah. Yeah,
But
best thing is to
that
make-
won't go against you. You just got to be clear that they're going to convert to equity, not to.
I can
repayment of
view
debt.
that as it's still a liability in your financial statements, but I can discount that compared to something like a credit card bill that
Slower
I know
risk
you're going
than
to
a
have
line
to
of
pay.
credit or something. Yeah, that's the idea. And especially if the later the maturity date is, the less of a pressing financial risk it is for your company, right?
Right.
And the other piece of advice I would give is the $10,000 that they provide for accounting systems or financial review. You could have somebody look at your financial viability, know going into this phase 2 where you stand, if this is gray or if you're looking like you need to do something, and take some action to clarify that prior to the 10-day notice where you've got to submit all your information.
Okay.
The program's going to send you an email, if you're technically recommended, saying, you have 10 days to provide a huge swath of information. And these are things that might not be real easy to do during that time period. So if you're making the best use of your time, I would try to have that all ready to go if you get the notice.
Okay, good.
One other piece of advice just relative to this is that that will happen, that's true. Typically, first of all, we talked about this yesterday, but just to reiterate, everything you're going to have to provide in that 10-day window is all publicly available on our website. So if you wanted to do it now for fun, you could. I wouldn't recommend going through the entire process, but it's good to know what's going to happen and if there's things you need to think about. If we go to a review panel and we think we're considering you for further diligence, most of you have been through in phase one, you've been through a kind of a back and forth that lasted 4 to 6 weeks. That's about technical and commercial things, responses, and us tweaking your budget. So typically the same thing will happen. If you're going to get funded, it's definitely going to happen to you in phase two. And again, some folks who get to that stage may not get recommended, but if you're going to get to their review, obviously you're going to be recommended by your program director. What will happen as soon as they start thinking they need more information about the proposal and the science and all that, they're also going to ask you for 3 pieces of financial information as a way to try to see if there's going to be an issue we have to think about. And those 3 things are your current ratio, your quick ratio, and your cash on hand. And you can look up all those, those are things that if you don't know how to calculate them, your accountant does. And those are kind of the things we use. They don't tell us everything we need to know about whether there's an issue, but they do potentially provide red flags. If your ratios are less than 1, that's an issue. If your cash is, say, below 5 figures, it's certainly an issue. It could even be an issue if you $10,000 to $20,000. It depends, again, on all these other things. But the point there is if there's a potential issue, the program director then has a little bit of visibility, and they can potentially work with you to understand if we need to do something. But the reason I bring this up is just to let you know that there is a little bit of a speed bump in there where you're not rushing towards this cliff without a regulator somewhere in there. But also that if you can predict right now, if you submit your proposal in February, this will be happening to you next May or June, right?
Okay.
You'll get this somewhere around there probably at the earliest. If you can predict what those 3 numbers are going to be in May or June, I would tell your program director and just see if they have any advice and start talking about it. Maybe the situation changes, but when I was a phase 1 awardee, I could pretty easily predict next May or June, at least what the worst case scenario would be for those numbers. And that won't give them, you're never going to get a green light that you're 100% sure to be viable, but it'll definitely give a sense whether we need to really start interventions financially or thinking about what we need to do between now and when you submit phase 2. So I would be proactive about it and certainly study about what you have to provide, but also think about those three numbers, the quick ratio, the current ratio, and how much cash you'll have. And, if you know what those are going to be, start a conversation with the program director. And, these folks are always, Charlie and Sohail are always great they're not going to tell you how to beat the system right. They're here to protect the government's money, not to let you get a phase 2 award. But they are great about answering questions about the process. They're responsive, and especially if your program director has gotten the question first and they know they can't answer it and they can filter that question, they'll send it along to them.
Thanks. At the end of the day, we want a viable company, so appreciate y'all's help.
Yeah.
Hi, I have two questions, two different ones. We have a license from a university. They invested the patents in our company for equity. The license agreement only says to us that we pay for ongoing patents and reimburse them for past patent expenses, about $120,000. So this agreement has been live for 3 years. We could not get to a place where revenue could pay for those. We negotiate with them every time there's a time coming up, and they push off another 6 months, and now we have the NSF grant, and we also have a separate consulting contract for about $30,000 a month for 2 years, which we are using to then pay down the university's past obligations. But to just manage cash, we're not doing it in one go. We have like a payment plan with the university, and I expect by the time we put a phase 2 grant, there will be $50,000, $60,000 left to pay the university yet. And the question is, do you expect to see that financial obligation on a balance sheet in the liability side, or what would you expect to see in that case?
I think if it's a debt owed, it would be a liability in your financial statement presentation.
Okay. That was a question from, I just, our accounting system is getting set up and our accountants are putting everything in, the project cost ledgers and so on. But it
And
was a
also, I
question.
believe their awards, SBIR award is very restrictive on patent expenses, so.
No, we are not
These would
spending.
be totally paid from another
From the
source.
consulting
Okay.
contract, yes, totally paid from the consulting contract. Yeah. So thanks for that. The other question is on payroll. So I downloaded a timesheet template that was on your website, just put our company's name on top. That's what we are using to track time. Have the supervisor, my supervisor, sign it. We are running bi-monthly payroll. And then I'm doing the payroll on Excel, have pay stubs in Excel. Then my outside accountant takes everything and puts it in QuickBooks, including how many hours were spent by pay period, by person in QuickBooks. Is that sufficient with this paper trail and split showing in QuickBooks what time was spent?
Do you want to?
You're here.
So if you're keeping it in Excel, Excel can be changed. I would recommend that you want supporting documentation that cannot be changed. So if your timesheet really is that Excel document, no.
We're printing. And
You're
then
printing and signing it. So your supporting documentation is that signed. Yes, when you said that your supporting documentation was Excel, that made me nervous. Because
No,
you
no.
definitely want something fixed that cannot be changed, that is signed and documented.
You're signed, dated, yeah.
Awesome.
I think as long as you can link it, you're in technical compliance, but my advice, particularly long-range planning, would be to have a more robust system that automatically links with your time and effort reporting system to your payroll, to your general ledger.
Okay. Thank you.
Hey, you guys. I have a terribly specific question that I don't think you're going to appreciate. But I have a novation agreement here. So we have an STTR, and we've been basically working to merge with another company, and we're transferring the grant from company A to company B. It's all signed and ready to go. I guess my question is, who's the right person to talk to about this? I think I found her. And how do we work with you to kind of get this through quickly? The reason why there's a constraint on time is because it's an STTR and we have a subaward who's at a university essentially waiting to pay their grad student. So it's important to us to get this through as fast as possible.
I'm the person you should reach out to. Amanda Morris is maybe the person you're referring to. She'll be the other person. I deal with the legal issues and, if, and she deals with how, basically, to oversimplify a little bit.
Okay.
We should talk about the details, but for any of you who are thinking about potentially being a different entity at some point between now and the end of phase 2, I mean, knock on wood if you get a phase 2, there's a few things just to since it's a specific question, but let me make 2 general points. One is that it is far easier, if it's possible within your company's strategy and timeline, it's always easier to finish the phase 1 with the entity that got the phase 1 and then transfer the right to submit the phase 2 to the new entity, because then no existing NSF award has to be transferred over from entity A to entity B midstream. Mm-hmm. In your case, it sounds like that may not be possible, and so what we worry about is 2 things. One is that, many of you know, setting yourself up in some of the non-NSF systems that are required for us to give you money is not under our control and can be painful and take a long time. The SAM.gov system, especially for the people who submitted phase 1 awards this summer, took over 3 months in some cases just to be able to go into our systems. Mm-hmm. So that would be something where, in your case, the new entity having all those active registrations that you know about is something that presumably you could start on, and that's high priority.
Yeah.
And then once that new entity exists in those systems, then talk to Amanda and I. But just remember that there's only ever one organization that NSF has authorized to spend federal funding on this project. So even if it's all the same people at entity B and you've got the same address and the same logo, NSF has not given that entity permission to spend any money, right? And that's you're obviously aware of that, which is why you're not saying, oh, I'm just going to cut the check to the university from this new entity. Right. But just remember that when we do the award, there's going to be a blackout period where you have no authorized entity that is allowed to spend money on the grant. So we just need to, so we'll talk about it. But the key word here, again, is if you can wait to the end of phase one, do it that way. And if you can't, let us know before anything starts to happen legally so that we can kind of coordinate.
Okay, thank you.
I don't know if I answered that question for you, but we can talk offline about your specific.
Okay, I might grab you after this session.
I need to ask you a few questions that I don't want you to answer in a public setting about the nature of this, so yeah.
Sure, okay,
Yeah.
thanks.
I mean, I know what your company is, and I know about I know about this merger, but there's some other, like, Dunn's questions and things.
Okay, thanks.
Hello. I apologize if you've already answered this question. I was in some one-on-one sessions, so my question is kind of on the showing company financial viability going into the phase two. Thinking strategically, knowing that the valuation of a company, our company would be dramatically different before versus after we receive phase two funding. In our case, we don't have any liabilities really. If I just stop paying myself, we don't really have any expenses or any other debts to pay in the time between phase one and phase two. How important is it for me to go out and raise some outside money, maybe at a relatively poor valuation, just to show money on the books? I actually heard, we should have 4 to 6 months of cash burn rate in the bank as cash during the cap review. I mean, is that like a check in the box, a hard and fast rule, or is there, any guidance on that?
I'll check it again. Yeah, we have been answering this question a bit, so I hate to be too repetitious, but yes. Basically, financial viability is one of the major concerns and the biggest single reason for an administrative declination recommendation from our office. We would expect that you have sufficient cash on hand, normally for 6 months of operations, and that could be determined by a burn rate, which is either total expenses divided by the time period or losses, if I want to do a net burn rate, over the time period divided by number of months. We would expect that you have liabilities that are less than your assets, especially current assets, current liabilities. That's the current ratio. That has to be greater than 1 or should be greater than 1. If you do have a lot of liabilities, we would look to see what they were. Were they convertible notes? Were they equity investments? Are they notes payable to the owner where they might not call those due? The concept of not paying or rolling up the sidewalk, so to speak, because I'm not doing research on this grant, isn't really convincing to me when I'm doing a financial viability determination to see if this is truly a going concern. I mean, I recognize that that can happen, but you're not really showing me that this is a viable business entity itself if it shuts off the lights when it doesn't have a grant. What revenue you have from other sources? Is the NSF grant the sole activity you're doing, or do you have consulting or other income, other things from states, other business opportunities? Are you profitable, or are you suffering losses? Do you have any equity left, or are you in a huge net equity position with all your losses? Those are all things that we look at with regard to financial viability.
Okay, and then on that, I think you did address this already. I heard just the last bit of it, but if we raised that essentially cash to have in the bank via a convertible note or something, as long as we show that note's not going to be callable until after the period of the STTR,
I can judge a convertible note less than I would a regular liability, and even notes payable to the owners. They could say, we're not going to call that due. You may also want to obtain letters of commitment from angel investors or other people saying date certain or milestone and dollar amount that I'll provide over this time period. Those are all things that we consider. And I suppose if you know that if you look at these, I mean, as an entrepreneur, you should kind of be a little bit aware of where you are financially, or you might have trouble in long term. So I think you should know what kind of shape you're in going forward, and if possible, prior to us doing our phase 2 review, line those up, because our review is as of. This is what is in place when we receive the package. So if you do have indicators of financial viability, I would recommend taking whatever steps you can to address that and be prepared to answer those types of questions head on.
So I think it also probably makes sense for you to, if you're going to raise money anyway, even if it's not because of this, you should talk to Nancy. I mean, this is true for any of you. There's no reason not to let us know you're thinking about raising money, even if you're in phase 2, right? You know, we have these portfolio of companies, and last year they raised $1 billion, right? And we were in all those deals, so we have some experience. Not to mention, you know, the experience we have in our prior lives doing that. But you know, the other thing I would say is the phase 2 review, right? This financial review is going to happen 3 or 4 months after you submit. Theoretically, if you were a company where your operations tailed off, you will have had 3 or 4 months kind of on starvation mode, right, at that time. Again, it's, you know, we have these external CPA firms that look at this information. You should make it clear, you know, what you've been doing, right? I think the fact that they're worried that they're worried about what burn rate you need to maintain any sense of existence for the company, right? Because there are ways to reduce, every company has ways to reduce their burn and stay viable. And then at some point in time, if you turn that number down and down and down, your employees leave, you lose your office space, you know, and there's something that's irrevocable, right?
Right.
But you should talk about, okay, we've had the last 3 or 4 months, you have to be honest, right? And I would be open about what's been happening, because if you don't tell them, okay, we're on this low burn rate and here's what we're paying for and here's our employees are willing to wait until the phase 2 come through, they have no choice but to look at your last year financials to calculate the burn rate, right? And I'm guessing your burn rate right now is a lot higher than it's going to be after you submit your phase 2. That's my guess. And so you should take the opportunity. It's going to be asked, you know, what is your burn rate, right? They're going to ask about this. And if viability becomes an issue, they're going to ask about, you know, what sources of support do you have and what are your obligations? Sure. So you should talk about, when they ask a question about what your burn rate is, you should give them a sense, okay, here's our normal burn rate, here's our starvation burn rate. Again, maybe it may be an issue if you're in starvation mode, but you are going to be in starvation mode probably, and so you should at least be honest about it.
Right, yeah, my question really is, I will have to raise money undoubtedly.
Yeah.
It's just a strategy as to take the money early to show CAP that I have money in the bank and maybe get a bad valuation and maybe screw up my cap table doing that.
Yeah.
Or wait till I get a phase 2, have a lot more prospects and get a better valuation for essentially the money I would need to do the things I'm going to do.
I'm sure there's term sheets that I would tell you to sign right now, and term sheets I'd tell you to tear up and set on fire.
Okay.
And it just depends on what the terms are. And again, even though there's a chance that a few of you will get declined for these reasons, if you screw up your cap table, Nancy may decline you for that reason too, right? Even if you've got lots of money in the bank, right?
Yeah.
So I think the important thing is here is to start that conversation, because that's a very context-dependent thing for you as a company. And you know, again, the other thing I'll say is, this is a really scary session. I remember, you know, being a grantee, and it is important that you guys do this, even if we don't do viability check, because you will have to raise money from somebody, and they're going to have all the same rules that these guys have. They're not going to want you to have a quick spreadsheet that has your accounting in it. No investor is going to touch you until you get, you know. So I think this is good training. It's a little scarier than it needs to be, but it's good training. But you know, my point generally is that you know, you have a timeline here between now and February is the earliest you could possibly submit, and so you have almost a year in any case before this thing happens. So I wouldn't make any rash judgments. I would try to predict where you're going to be and start that conversation, and know that every year, you know, we award we award about 120 phase 2 companies, and almost all of them are pre-revenue startups without a lot of other sources of funding, right? So there are ways to get through this, but you just have to manage it. Right. It's like any other risk.
Thank you.
2 questions. First one is, we have a sub-awardee being a university. Are you going to look through me to them for their timekeeping piece for the grant? Right? Do I need to pull the data from Morgan State to justify, you know, they get $25,000 out of this? Do I need to be able to pull that data from them?
They should have that kind of data available, particularly if it's a large college or a major university. I would view that as relatively low risk. I don't think you are required to pull that data or have copies of their timesheets. I think if you had an issue with them not performing, then you may want to ask them some questions about what they're doing. But I think your due diligence would be that this is an established college and university that receives, I don't know how much
Right.
funding. You could go to the Federal Audit Clearinghouse and pull down their audit report, or if you wanted to, but I don't think that you have a responsibility.
You're not gonna ask
as your
me.
organization to say, Morgan State, show me your time and effort reporting cards and your time
Right.
policies and procedures. I think that would be a bit overkill.
Okay, I just know that if you said in the next 10 days, deliver it, they couldn't respond in the next 12 weeks to get me that data. I'm sure it's there. It would just take forever to
Our
actually get.
requesting the time and effort cards and the
From the
project
grantee.
cost ledger applies to your organization, not necessarily to your sub-awardee organizations. You would have some flow-down requirements from the terms and conditions of the grant and award, but I think most established universities would be fairly low risk.
Okay, that's fine. The second one deals with indirect costs. So I forget what our number is, 40% of our wages. Are you looking at the last calendar year, during just the period of performance? How are you judging that indirect relative to?
You have two options with regards to indirect under the Phase 2 SBIR program. One
Well,
is
during
what-
phase one, in terms of what you're going to audit.
Oh, for what you've done in the past? It's generally not subject to audit, but I think that the Office of Inspector General does look at some Phase 1 cost awards, and basically, if you use the safe rate, you can claim up to that amount without having to provide documentation for it, which is why vast majority of our awardees are going with the safe rate.
So if you're
currently.
within the safe rate, you're not going to, assuming we're
I
not
don't
using it
ask to
for.
say, show me the indirect cost ledger, let me pull transactions to make sure these are all allowable costs. If you go the other route and want to claim your full indirect up to, I think there's a ceiling of 150% of salaries and wages, then we would request a proposal and you would be required to maintain documentation to support that rate.
Safe rate is good, thank you.
You know, the safe rate is safe for us because you're probably not going to recover your full indirect, considering that 50% includes fringe benefits and paid time off. So
You'd be surprised.
if they are lean in starvation mode, they might be able to fit through there.
When we started, our indirect rates our actual indirect rate for our first 2 years was below 30%, including fringe. I paid myself very little and had very bad insurance. We were allowed to not have insurance in those days, let's just put it that way. Go ahead.
Hi, guys. Thank you for providing this forum for us. So I have, my question has two components, but they're both related. So is there a threshold beyond which, your spidey senses will start tingling for, one, how much the company has raised, and second, the cap table, and by that I mean the proportion ownership?
I'll allow Ben to address the cap table.
So just to clear, the cap table is a concern for the technical and commercial review, which your program director will do with external reviewers, right? We talked about we had commercial reviewers who talked about this yesterday, and we bring in technical reviewers. So I don't think you guys care that much about the cap table as long as they're eligible, right? So in that sense, we're looking at the cap table the same way anybody who is trying to understand the potential commercial success of your company would look at it. In other words, there are structures that are more likely to be commercially successful and structures that are less likely, right? So if your cap table, if you have somebody who owns your whole company who's not engaged in your company, that's an existential risk.
Got it.
Because that person can shut you down if they have a bad day and they don't appear to be as invested as if the people who own the equity are fully engaged and working for the company every day, right?
Got it.
Equity in your company, just as a reminder to all of you, is not a reward for past performance. It's an incentive for future performance. And you should think about it that way. Equity is one of the assets you have, right, at your disposal. You don't have a lot of cash or kind of tangible assets. Equity is one of the tangible aspects you have, and obviously it means more if people think your company is going to be successful, but it is something you should allocate to maximize the increase in the chances of success. And obviously, different stages of your company have different appropriate equity structures. So we look at all that, and we look at it in a context of the company structure and the team, right? If you have a team where the key people doing all the work don't have equity and they're being underpaid, that's potentially an issue because there's a team risk. Why is this person going to stick around, right? If they have equity, they're more likely to want to stick around and work hard. So we look at that. And the other question was around an issue with raising too much money. Is that what I heard?
Yeah, I was wondering if that's potentially an issue, yeah.
I guess there's theoretically an amount of money you can raise where phase two, it's potentially an argument against getting phase two. It's pretty rare, right? So we had a company that was here, your predecessor cohort, there's a company here in March where during the March meeting, they raised $51 million. I'm not sure what happens to that one. I suspect that will be a good and a bad thing. It's a good thing in the sense that that's a great company. The question is, do we need to put more taxpayer money into it, given that they have that amount of war chest? My guess would be, since you're trying to ask this question to understand whether to take that money, if you need to worry about our grant funding, it's probably not enough money to make it a bad thing. You understand what I'm saying?
Yep.
The amount of money we would need to start thinking we don't need to give you a phase two is something you should take because it's way, way more than we're going to give you in phase two, right? So for me, I've had companies that have raised up to $10 million in phase one that have gotten phase twos, right?
Perfect.
But I don't know. There's not a hard number there. But like I said, it's very unlikely to find yourself in that position. And, money is great. The phase two is not the best thing in the world, You can raise more money from smart investors who are aligned with your mission. They're going to give you a chance to go after it. There's a lot of, our program is great. I love our program, but there's a lot of, for all of you, there's better money out there, right, in some form. Maybe not yet, but eventually there will be money that you should take, even if it means giving up our money, because you have to grow as a company.
Very clear. Thank you, guys.
Mm-hmm.
This is to Charles. I just want you to finish what you started saying a minute ago about indirect cost in phase two. You said there are two options.
Yes, you can use the safe rate, which is 50% of salaries and wages, but it has to include fringe benefits. And you need no documentation whatsoever, and we will approve that without further review. You also have the option of calculating what you believe your real indirect cost rate is. There's a guidance of indirect cost rate submission, and you can be eligible to be reimbursed for that rate as long as that is less than 150% of salaries and wages. They do cap that. There are also some limitations if you go the, what I call long form calculation of the indirect, that are program specific, in that we don't include IR&D, sales, marketing, patent. There's several other expenses, commercialization type expenses, because they really want to focus on the research, and we don't include those as either direct costs or indirect costs. There's also a limit for, 30% of indirect salaries and wages into the indirect cost pool, but there are several limitations. But an organization is eligible to request higher than the 50% safe rate.
Okay, thank you.
Everybody's too scared to ask questions? No?
Do you want me to just make some comments on common issues that we identify when we're doing our budget review? That might be a useful topic to spark some conversation. First off, salaries. Salaries is one of the areas that we do frequently recommend adjustments to the Division of Grants and Contracts. Generally, if you have adequate revenue streams and you have a payroll history, we will accept the salaries that you actually paid. For most of the startup companies that don't have adequate revenue streams and/or salary history, We utilize the Bureau of Labor Statistics Standard Occupation Classification Codes and use the BLS mean. We typically use the location specific as opposed to a national average. So we can drill that down to the different areas that the company is, and we would use the small business location as our basis. Other issues, I think, are whether individuals are truly employees or whether they're more appropriately classified as a consultant or a subcontractor. If they're a consultant, I believe there are some consultant limitations contained in the solicitation. This can also sometimes have an impact on eligibility as far as the percentage of the research performed by the small business company if individuals were reclassified from employee to a consultant or subcontractor position. And I think we just went over the indirect. Can you think of other areas we frequently make budget adjustment recommendations for?
Yeah, mostly salaries and wages is the area.
Can I ask a follow-up on that?
Yes, sir.
So we use almost exclusively people through Upwork and people who are remote. So we're paying them W-2 and classifying them as employees, but is that going to be, are you going to want to reclassify them so they're not at our physical location, they're not using our own equipment, and they're paid hourly?
But they're employees of your organization, right?
Yeah, W-2.
Yeah, should be W-2, yeah.
Okay, so
Should be fine.
Perfect, thank you.
Yeah, this day and age, it's not unusual to see telecommuting or people even working in entirely different cities.
Hi. So I'm thinking of bringing on a subcontractor that's an LLC, but it's owned by a resident alien. Is that ever an issue from like the flow down perspective in terms of how that works?
You said it's a permanent resident who owns it?
Yeah, it's a permanent resident, but not an American citizen. It's a French citizen.
I don't know of any distinction between permanent residents and American citizens for anything around our program.
As long as the activities happen in the U.S., it's okay?
Right, yeah.
Okay.
So I think as far as
like
any of the eligibility requirements that have to do with the nationality or
Okay.
immigration status, I think I don't know of any difference between a citizen and a resident in any case, but I'm pretty sure from my point of view that we don't have
pretty
an
much
issue
the
with that.
same, right?
Yeah.
Okay, so it should be good.
I think,
If they were-
I think
yeah.
it says legally eligible to work.
I think
So-
actually that's NSF policy that there's no distinction. I mean, if you were in the DOD, it might be an issue.
Right.
You know, citizenship sometimes becomes different than a resident, but I don't think at NSF I've ever seen it.
Okay, great. Thank you.
Good afternoon. Our company is formed by 4 partners who developed the technology and have invested in the creation of the company. And we're an LLC, and as partners, we're not eligible to be employees because it's an LLC. So the partners are being paid a guaranteed payment for a minimum amount of work that they're performing. So we were considering switching to an S Corp in order for them to be employees. My question is, what is your assessment of a company that is run and developed by partners that are paid through a guaranteed minimum payment for the work that they perform?
I'm not sure if this is an accounting question or a technical program director question. I guess if it's an accounting question, I guess correct me if I'm wrong, but I've heard this question enough and I've heard them answered enough. Let me paraphrase. From the point of view of our review, if you're you can't be an employee of an LLC if you're own units, and so if you take a salary draw essentially and have timesheets the same way that employees would, you're essentially treated the same way as an employee from our point of view of our process. Is that right? Am I right about
Guaranteed payment.
that? Guaranteed payment.
Because a
sorry,
draw
yeah.
might be against the profit.
Right.
So I would prefer the term guaranteed payment.
It's a guaranteed payment
Right.
against a timesheet.
Yeah.
Yeah.
You can do that.
Okay.
From the general review point of view, when we're looking at this as program directors, again, which is where most of the declines happen at phase 2, it depends a lot on what the company wants to be when it grows up. There are a lot of advantages to starting as an LLC, and then there's some folks who are going to need to become a C Corp. S Corp, we heard yesterday about some issues with S Corps. We don't have a lot of S Corps. So if you're going to, and again, I'm sure you have reasons to do that instead of a C Corp, but if you are, if you're looking to raise institutional capital, you can't do it through an LLC, right? You're not allowed, it's not legal.
Okay.
So if your company has a business plan where you need to raise that kind of capital, you're not viable as an LLC. And that's okay to start as one, but eventually you're going to have to talk about when that's going to happen. If angels sometimes, invest in LLCs, they don't have the same, constraints. And so if it's angels or if you want to bootstrap, and there's some companies where you can do that, although it's rarer than you think to be able to really bootstrap all the way, even with a Phase 2 award. And so I think it just depends on, like I said, what your capital needs are, what your company's aspirations and kind of ambitions are. Just to be honest about, having seen a lot of companies go through this process, it may be from a different source, but any company that we've seen that's gotten close to kind of you guys all have big dreams, which is great. Any company that's gotten close to those big dreams eventually has, by the end of Phase 2, raised 7 figures or more of money from somewhere, because it's just so hard to do without someone else helping to pay the bills. And it doesn't mean you have to become a C Corp and take venture money or raise even equity investment. It may be money from another part of the government. It may be from foundations. Maybe that you can bootstrap well. But if you don't have someone else writing checks in Phase 2, maybe you survive, but it's very rare that we look at you and say that is a top success story from our program. And so I would think about that.
And so that's generally not an LLC, you're saying it's more of a C Corp?
Well, we have LLCs that do that, but they're able to be an LLC and take in other capital in ways that are appropriate to an LLC, right? Okay. Like I said, if your 5-year pro forma that we've talked about, if you're preparing it for Phase 2 and there's 8 or 9 figure investment, cash needs on that, I don't know how you do that as an LLC. I can't imagine anybody with that kind of size of a checkbook would put money into an LLC, because there's no controls or governance around that, right?
Right, yeah.
Those people who write those checks, they want to know who they go after with their lawyers, and LLCs are almost impossible.
Okay.
Right? I mean, to be very honest, that's what they want to have governance. That's why there's laws saying they can't put LP's money into your company unless you're a C Corp.
Okay.
Yeah.
Okay. I think I got it. Thank you very much.
Yeah, sure. Talk to your program director, by the way. They're the best person that I know of to understand companies in your situation and how they grow up.
They asked me to come here.
Huh?
They asked me to come here.
Okay. Yeah.
He's getting this redirection.
Hi, I'm 60% of my time on the STTR program we have, and I'm paid at the BLS rate that the program director pointed to back during the Phase 1. And now that we have this consulting contract, I'm spending 40% of my time. And the rate at which I'm getting paid from the consulting contract, which is other money from a customer, is a different rate. It's a higher rate than the money I'm charging to the NSF, which is the accepted or the negotiated BLS rate. Is that a problem if you see it on a pay stub, that there are 2 items saying one section is as a PI on the grant, another section is as CTO of the company on this consulting program?
I think you should get more money when you're consulting for the other entity, and that's okay with me.
Okay, thank you.
Yeah.
Yeah.
So it's both of them are a revenue stream, right? You're charging, we recommended you with the BLS, that is the NSF grant that you're receiving, and also you're receiving revenue for the consulting service that you're providing.
Yeah.
But in the books, you have a different rate.
Yes.
You need to speak to your accountant, to set it up in the system. It should be, as far as the only implication I can see is a timesheet. When you're setting up, say your consultant work should have a different code than the NSF effort that you're putting in.
It does.
But other than that, it has nothing to do with the revenue stream that you're getting.
Okay.
Yeah.
Thank you. Just to clarify, because I'm learning too, it matters who the consultant is writing the check to, right? I mean, if the consultant is writing a check to you as a person, that's a 1099, you report that differently, and that doesn't touch the company's finances. If the consultant is writing a check to your, to the same entity that we gave the grant to, Then I don't know. Can you actually, I don't know, is it possible to have, because you have an employment agreement at a given salary rate with your company, presumably?
Yeah, it's an LLC.
LLC, okay, so you don't,
I'm a
okay, maybe you do.
partner.
So then I don't know, actually, then I'm not sure, then that's an accounting question. If you were a C Corp and you had an employment agreement and you were paid as an employee, I don't necessarily know, Christy, I don't know if you're nodding your head, but I don't know if your employment agreement allows you to change your salary. I think legally you'd have to just ask your accountant or your lawyer how that works.
I mean, that's consultant revenue for the, if the check is going to the company.
Yeah.
Then that's consulting revenue to the company, and it
Right.
doesn't change your paycheck.
Yeah, so that's what sir, what she said, just because you're not mic'd, is that
Yeah.
your company can charge whatever hourly rate it wants, but that doesn't necessarily entitle you as an employee to take home a different amount of money. So when my company did service as a per hour thing, we charged big semiconductor companies $500 an hour for me to run a tool and give them feedback. That doesn't mean that I get $500 an hour, unfortunately, for that. I was still paid the same hourly rate that was in my employment agreement, but the company booked $500 per hour.
Yeah.
Well, and the money
So I think it's important to understand just who is the agreement between the
The
consulting
money
agreement.
you're charging for consulting work should be greater than what your salary paid is. It should
Yeah.
include at the bare minimum indirect, fringe
Yeah.
benefits,
It is.
element of profit.
It's an LLC. The money is coming into the LLC. I'm a major partner in the LLC. The work I'm doing for the STTR program, I'm getting paid the BLS compliant rate. But the work I'm doing for the consulting project, I'm getting paid a higher rate. And essentially, we negotiated between our partners. They're all okay with it. I talked to my CPA. He seemed okay with it. He said, ask this question, and then come back, give me feedback, and so on. So there are two rates that I'm charging, essentially, my company. And then there's a big spread between what I'm charging and what the customer is paying to the company also.
I think it's two different things. Yeah.
I think we're gonna have to close loop offline.
Okay.
Yeah.
Hi, I have two questions. Yesterday, we were talking about the consultant doesn't need timesheet. Will the agreement with all the information like project, scope of project, the amount will be suffice in the agreement, or will also need invoice along with that?
You're going to have this is a different consultant question. You're hiring a consultant to work on your grant.
Yeah.
Yes, what we would want there is a scope of work, a consultant rate of pay, an estimate of the level of effort required, number of hours, days, whatever.
In the agreement?
But, yeah, we don't require actual timesheets. When they invoiced you, I would probably expect that similar type of arrangement, that they would say, so many dollars, so many hours, or so many days, this is the total, plus travel or whatever other incidental expenses, and this is the amount that we're claiming.
Okay. Another thing is just now you mentioned about the project cost ledger. Is there some kind of template that is it able to, for us to see it uploaded? You mentioned that.
I guess I visualize one in my mind because I've seen enough of them, but generally what you expect to see is a list of expenditures that can map to the NSF budget type expenses, even if you have different account codes. You can say these ones are all salaries and wages, these are all materials and supplies, whatever. Then across my columns, across the top of the page, I would expect to see budget, actual expenditures year to date, amount remaining, and some cases we'll see obligated funds where you've got a commitment, purchase order, or subcontract out there. So you kind of know where you stand. But that's kind of how I visualize a project cost ledger. And then, of course, the title of the NSF grant on the top and saying that these are these funds. And then the different project cost ledgers would all feed into your general ledger that would show your total organizational expenses.
Okay.
But you would need a separate project cost ledger for each grant or direct cost activity your organization did.
Okay, thank you.
Hi, I came in late, so I'm sorry if this question's already been asked. Just a quick question about timesheets. So I had thought that the timesheet just needed to be an accounting for time for the NSF project itself, that each employee or person who works on the project completes. Do you expect to see other activities on the timesheet? Like, do you expect to see in my 40-hour work week, here are the 10 hours that I spent on the NSF project versus the 30 hours I spent on other things, or is it sufficient to just be accounting for the time for this project?
The time and effort report should encompass all activities that you perform for that organization for which you are paid.
Okay. So if we haven't been doing that, can we now say, okay, starting from now, we're going to do that, here are the ones that we did before, or do you want us to go back and try to guess?
You got another card, Ben? Basically, no, I'm joking. I don't advise you to go back and create any records today that you represent as being contemporaneous or created earlier. If you are to go back and want to obtain an idea why you have documentation that such as lab notes, journal entries, calendar that you keep on your cell phone or on your email, whatever, I think you should be extremely clear in stating that we didn't know we had this requirement. We're going to go back, particularly if you're ever asked by the Inspector General or something like that. The idea of creating documents now, it has to be very, very clear that you're just trying to get an understanding of what occurred in the past and be absolutely straightforward and note that these weren't generated at the time frame that we had this. So
Okay, got it.
I don't know that I would want to go back and complete a bunch of biweekly time cards and sign them all off, as opposed to probably more of a macro exercise of, I've billed 40% of my time to this NSF grant over this period. How can I show that I did that effort, or what kind of documentation can I leave as what I would call not primary source supporting documentation, which would be the time and effort report, but more of a secondary source documentation, because they can, if it looks like you did it and you did the work and you just failed to complete a time card because you didn't know of the requirement, you're going to be viewed significantly differently than if you don't have any lab notes and no documentation to show you were actually doing work on the grant. If that.
Well, it sounds like you have basically all the documentation you would need to justify, say, a project ledger to show how eventually all the costs on the phase one were legitimately charged to our award. So you're in a better.
Yes, we've been doing timesheets. I just didn't realize that they were supposed to be accounting for all the time besides the time for this project.
I would just do them going forward. If you wanted to, I mean, you know how to, we've talked before, so you know how to reach me if you wanted to get kind of a document in writing. We can talk about your situation offline.
Okay.
I think the reason, I think, and correct me if I'm wrong, but I think the reason why that's important, some people would maybe think, okay, why do I need to tell NSF? So for example, if you're trying to do an indirect rate proposal, what you do with non-NSF hours is going to be material to understanding your actual indirect cost rate. So these are all things that even if you're not above the safe rate, somebody will eventually need to know that. That's just good practice to start putting it on. And when I did this, maybe you guys want to cover your ears. When I did this, for a while, if we had something we were doing out of sweat equity, we would just have another category, right? So I had time where I was just not getting paid, right?
Yep.
And I put hours on a timesheet, but I didn't bother classifying them out because sometimes it was hard to determine. There's no source of funding, right? There's no money, right? So, and then eventually I started to do customer engagement was like a line. So eventually I got more sophisticated. But I think right now the most important thing is going forward that you have all of your hours every week accounted for in some form on that sheet.
Okay, that's helpful.
Is that fair? Yes, no?
Yeah.
You're trying not to insult me in front of the grantees,
No,
right?
I appreciate your having been in my shoes. Yeah, thank you.
Thanks.
I appreciate your time, and another timesheet kind of follow-up question that she had. We've been not tracking our hours the same way, so we've been tracking the NSF hours, and we weren't cost coding them all, but we also were not tracking our business hours, so we also aren't getting paid right now. So we're doing work, we're just not tracking those hours. So we'll follow a similar process that you just discussed. So that takes care of one question. The second would be around the, we actually had our pay rate slightly like $2 or $3 higher for the first paychecks that came out of the NSF. And so our accountant suggested that we do an adjustment line to that. Is that the proper way to make up for that, where we've reduced the hourly rate down by like the proper rate to $3, or, you know, reduced it by $3? We're going to go back and do an adjustment. Is that the proper way to handle that? I'm not sure.
Do I
$2 or $3
understand the
an hour.
question?
Per hour,
$2 or
right.
$3 per hour, okay.
Right.
Yeah, it's $2 or $3, don't worry.
Doesn't matter, don't.
No, per hour, I suspect you want to think about it.
So you had a rate that you charged, that you budgeted for the NSF grant, and you actually paid yourself slightly more?
So, right, it was based on hours and calendar months, and so there was a rounding period between the weeks and the months, and so when going back again, we just kind of did that math again and realized that it was $3 an hour more than what we should have been getting paid. So now we've reduced that cost by the $3 going forward, and do we need to make an adjustment to the 6 weeks that we've been, or, you know, 3, 5 paychecks, whatever it may have been?
They should be charging actuals to the award, what they were actually paid, right?
Yeah,
Excuse
but
me? I didn't know.
If you can't hear,
I was waiting
you
for
know.
him to say yes.
Okay.
Do you want
Yeah.
jump right in?
So what you should be charging to the award is the percentage of what you were actually paid. So you're not charging budgeted dollars to the award. You should be charging based on your actual
Hours.
pay. Yes.
Hour,
Hours
right.
and dollars.
Yes, your actual hourly rate that you were paid should be what you charge to the awards. Your project cost ledger should be accumulating your actual cost. Does that
And
help?
It does. So, I mean, I'm just going to, hypothetically, it's $10 per hour that we should have been getting paid. We had been paying $12 an hour. We saw that error. We want to go forward charging $10 an hour. Do we need to do an adjustment of any type for the,
You were actually paid hypothetically $12 an hour. Your paycheck represented that was the actual cost your business incurred. So now you may end up at the end of your award that you've charged more salaries than you have money that you available to draw down, because you paid yourself a little bit more. But the award, the project cost ledger should be capturing actual cost. So if you paid yourself $12 an hour, your company incurred that cost, so you should record that cost.
even
Anyone?
if it was higher than the approved hourly rate?
Because this is a fixed price, a pseudo-fixed price award. You're not, then you actually incurred the cost. So yes, I understand it was a little bit higher than your budgeted rate.
Okay.
And then, of course, then at the end of the award, you may not have money left to draw down, but you're still paying, theoretically
Right.
paying yourself.
They're still going to expect the level of effort that you
Yes.
put forward.
Sure,
Yes.
agreed, absolutely. We were just concerned about that position had a rate that it could be paid. And so if we exceeded that by any amount, because it was like a system technician, I think is the actual role.
So I'll email your program director. I mean, they'll give you guidance, and
Okay.
it'll depend. But basically, I think, you know, to follow on Christie's point, at the end of the, you know, if you keep going and you pay yourself the rate that was approved going forward, at the end of this, you'll end up with either having to spend a little more on salary than you expected, or having to lower your commitment. Both of those things are things that, you know, if there's enough, if that size of that difference is enough, that your program director is going to need to kind of to weigh in on anyway. I suspect, you know, the worst thing that happens here is they make you cover the excess out of your fee.
Sure, and there's
but-
no problems there. We just want to make sure as far
yeah.
as the legality
Email them
type
with
of-
like where you're at and where you thought you'd be at, and they'll give you guidance.
Okay.
Yeah.
All right, great, thank you all
Yeah, that's
very much.
those
Appreciate
kind
it.
of questions, like budget modifications during an award, typically are handled with the program director, and if they need to drag in any of these folks to give guidance, then they will.
Okay, great,
Yeah.
thank you.
Sure.
Hi, a quick timesheet question. The Phase I award was our first revenue into the company. And I heard the webinar, the CAP webinar, right before the grant started. So starting on June 1st is when we first started keeping timesheets. So when we go back in 2018 and start looking at it, there's a timesheet starting June 1st. We didn't keep track of our time before that. So is that an issue?
I mean, technically, you were probably responsible for having timesheets all through the award, so I can't give you a get-out-of-jail-free card with the OIG.
No, but their award didn't start till June 1st.
So the date the award started, we had timesheets from that day on.
Yeah, if you didn't
So-
have any money coming in and anybody working hours, then why would you have a timesheet? I mean, again, I don't know, maybe but my
Oh,
sense
oh.
is that if there was no timesheet, no payroll, no revenues
No,
before
yeah,
that,
nothing.
I don't know why you would need to have that, right?
Okay.
I'm sorry, I
Yeah.
misunderstood the
Yeah,
question.
I think a lot of people are in
I
that
thought
same,
you'd-
I suspect a lot of you are in that same boat where you had no financial existence for part of this calendar year.
Yeah.
And we encounter that a lot, and I haven't seen it trip anybody up, but.
If that's the situation, yeah.
Yeah.
But if there's other functions going on, other activities going on before you got the award,
Yeah.
then we would expect that you have a timesheet, you're keeping track of your time.
Yeah,
But
yeah, there was no
this
money.
is the
Of course, I
case,
was, I was trying to develop business, but when there's no money, I wasn't
Right.
keeping track
Yeah,
of
you're
it.
good.
Yeah.
Yeah, okay.
Hello, I've got two questions for you guys. So the first one is around convertible debt. And so we've taken some convertible debt and we want to make sure that, we don't necessarily have or expect to have for the phase two other assets that would balance that out to get to the current ratio that we've been told that you would want to see. Would it be sufficient to get letters from the convertible debt holders saying that they wouldn't collect the convertible debt either during the time period of the NSF Phase 2, or would we need to get that to be convertible equity instead? Get them
Sufficient is a
switched?
term I wouldn't use because we don't want to make those kind of overall encompassing judgments. But yes, I would view convertible debt very differently from another liability if I had the note holder stating that it wouldn't be due, or if the terms and conditions didn't show it being called due, or if it was the safe type note where the only option is converting, then we would view that very differently from a standard liability that was payable.
Okay.
So your last question was whether you should convert to convertible equity, and if it's convertible equity, it doesn't show up on your balance sheet. And so in that case, I think that it probably wouldn't affect your viability, is my understanding. I haven't seen convertible equity.
It would be very positive because then I would have a big dollar amount that moved from a liability into the equity section
Right.
of the financials.
So again, that typically for our companies is a balance between, it's always a net, it's always not just a net, it's a pure positive from our point of view in terms of financial viability, but obviously having to go back to your investor and ask them to do that potentially costs you capital with them, and so you have to weigh how willing they are to do that and how willing you are to ask for that and whatever that means for your relationship with them down the road. So again, if you want to get into that detail, I would talk to your program director, but if hypothetically that investor has zero, you affect your relationship with them not at all, and you don't affect your relationship with other investors, convertible equity is better than convertible debt without any downside, in my experience. Again, your investor may see a downside because there are certain things investors are afraid about when they get rid of the balance sheet feature, right? They're worried about seniority of assets and things like that. I think there's ways to mostly get those features for an investor, but some investors are not forward thinking around that. But if you think your investor is willing to do that and they're not going to feel like it's an imposition, then I would just go ahead and do it. But yeah, talk to your program director if you want to kind of think about the texture of that decision a little more.
Yeah, and then if they don't want to do it, and we get
it's-
another letter from them, would we
Yeah.
look to say they wouldn't claim it in that time period, or that they'd agree not to collect from NSF money? How would we?
I think all those are better than
Look at
nothing, but not nearly as good as actually changing the instrument. And there's various modifications that have various levels of positivity, I think, from their point of view. Nothing gets you clear other than taking it off your balance sheet as a liability, for sure. But some things may get you across the finish line. It's just you don't really know. So I think the next best thing, other than again making it a safe note or convertible equity, is to make it clear that the maturity is way beyond the phase 2.
Got it.
And or make it auto convert with some kind of crazy terms that you're never going to allow to happen, right? So the other thing you all can do is you can put in a price where if in 2023 you haven't had a qualified financing, they get some ridiculously high amount of equity. And obviously the point is that you're going to try to make sure that you convert before then. But the point there is that when they look at it, they don't see any way that someone's going to ask you for cash, right? There's no case in that legal agreement. My sense is that there's no way that you would have NSF cash and you would have somebody demanding cash. That's the thing that they want to avoid, right? They don't want you to like have somebody demanding dollars right now, and the only thing you have in sight is our grant money, because that's a dangerous place to be.
And you use the NSF grant funds to pay
Right.
this other debt. that
But
was
if there's a
incurred.
legal agreement where it doesn't say there's any way for them to say, I demand cash, especially while our grant is going on, then I think it's a little bit better situation. So again, those are all things you should talk to the program director about, because they can kind of, they can always, these folks they can't really weigh in until they know what the specific changes you're trying to make will be, and even then they're not going to give you the keys to their process. But the more detailed you can get about what you're going to do with your investor, the more I think they can help give you guidance. And so I would just talk to your program director, and they will bring in Charlie and Sohel to help negotiate, not negotiate, but give some feedback if possible.
It's not
Right,
really
yeah.
a mystery box that these all things fit in. It's just there's so many different variables to consider. It's impossible to give somebody a one-size-fits-all description.
Yeah. Well, that's very helpful guidance, though. And then the second question I had is around the timesheets. How do you like those to be tracked? I mean, we saw an example timesheet. It was a Google sheet. Then we've been told that, just having the document isn't good because you can change it. Do you want it to be like printed out and signed?
They can be electronic, they can be in any form. What's important is that you capture your full effort, 100% of your time is what we call it, and that you have an ability to track what you're doing, what the different, and you as an employer should probably want to know what your different employees are doing, what projects they're working on, what areas, what business segments or activities are profitable or not profitable. If I don't know what time people are spending on things, it's hard to determine where I'm making money or losing money. But yes, we expect the timesheet to have codes for the different direct cost activities, the grant or other grants or consulting work that you're doing. I also think Ben made a valid point on if you have indirect cost activities, you're going to want to have a way to track those. And I think just as a management tool, how much time are we spending on commercialization efforts versus consulting work or market development, or what I would use the timesheet rather than thinking of that as a burdensome reporting requirement, which a lot of people do, this is wanting to know where I'm spending, what my people are doing, where I'm spending my time.
Okay. So just a digital format is okay, though?
There's
in
no
terms of
requirement that this has to be in a paper copy. It
okay.
could be digital format. You can have electronic signatures. Yeah, the options are up to you. I would recommend that it reconciles to your pay periods for ease of documenting the salary costs and where they went to. And it can be either hours or percent of time. It's your choice.
Okay. Well, great. Thank you.
Okay, another quick question on timesheet. I'm 100% to the company. There's a salary that was defined in the budget. So I basically took that, divided by 12, and I'll pay that to myself every month for 12 months. As far as documenting the hours, so far I've been as good as I can, try and keep it about 40 hours a week, time on task during the day, but there's always, emails or travel or doing some research or something in the evening. I mean, it's not ever exactly 40 hours. And in the future, I could see as we hit more milestones, maybe I'll put in 50 or 60 hours. I won't change what I pay myself for my salary, but is it okay then to have timesheets, or should we have timesheets to show 50, 60 hours, or random, more or less not 40 hours?
Yeah,
consistent?
certainly the timesheet should reflect what you actually worked, or you have the option of doing a percent.
Okay.
If you don't want to do hours, you could 100% of my activity was on this project, or 50% was on this project.
Okay.
And everybody understands that this isn't the microscope look at what you do, that you can answer an email or pick up a telephone or something. I mean,
Yeah.
I would use typically a 5 or 10% sort of margin of error as far as what you're doing. And I mean, it's just trying to provide a record, a documentation to support the salary allocation to the particular award or other activities.
Okay, great. Thank you.
Just a quick clarification on that one. When you say, percent time on an activity, so, I'm PI on the grant, obviously, but, a large portion of my time is spent on the business side, business activities. Can I just put 100% on this project, even though most of the time is business activities, or only the percent time on the project is the pure technical part?
You should have the percent on the project and a different percent that you're doing your commercialization or other activities that you may want to consider like an indirect.
Okay. So the percent on the project is just the technical part?
Yeah.
Okay, perfect, thank you.
Yeah, just to keep in mind, I mean, people always ask this question, so, we talk about commercialization 24/7. When we bring you here, we don't pay for that. That's
Right.
a pretty big disconnect. We understand that. Congressional mandate basically says SBIR funds are for R&D only.
Right.
So as much as we'd love to, and again, we support you in a few little ways, but we understand that we're leaving a big gap in supporting that. So you have to make sure that what you're doing is not only kind of in the overall spirit of commercialization of technology that we talk about, but that when you're charging hours to our project, they are R&D
Right.
or related or allowed indirect costs related to the project. Those are the only things that we can eventually pay for. And
So-
obviously, if they're indirect, we pay for it as indirect costs.
Got it. So managing the technical team does count, right?
Managing a technical team is direct cost because you have to do that to get the project done.
Right.
So that's fine. Yeah.
And if the percentage time charged direct to the project is less than 50%, that's okay as long as 100% of my time is on the company?
Again, there's no, 50% time is a separate requirement, and it has to do with anything you're doing for the company.
Okay.
So what it means
That's
is
what I
that your timesheet for this company has at least 50% on anything you're doing as an employee of this company.
Right.
Right,
But
that's the requirement.
only a section of that gets charged to the project?
Correct. The
Okay.
requirement on the project that you commit to the project that you're actually charging us money for is determined in
Right.
your approved budget.
Got
That's
it.
the requirement
Got
that
it.
we ask.
Okay.
Yeah.
Thank
that
you.
meet.
Hey, how's everybody doing? My name is Derek Drakeford. I'm with Drakeford Scott and Associates. Thank you for your time today. I know this is a lot. This question might have been asked earlier. I just came in, forgive me. I get the timesheets for our full-time staff. For the contractors, what we've been doing is having them invoice us every month. What's your suggestion?
That's good, yeah.
The contractors or subcontractors or consultants would not be required to fill out your company's timesheets. So they
just
could provide you an invoice.
invoice what they did in the invoice.
Mhm.
Awesome. Thank you so much.
Now, their own organization may require that they have timesheets, but you're not required to obtain that information from them.
Okay. Thank you.
12:36. People are probably hungry or tired or afraid by this point. Any last questions? One more? Anyone?
One small one. So when the timesheets are signed, I'm the one who signs all the timesheets, but I have to find someone else to sign my timesheets, right? And that should be done through DocuSign or some, non-changeable format for the
I
timesheets?
can't recommend a particular vendor, but yes, you can have an electronic signature, and I would think for internal control, you would want somebody else to sign off
Okay.
on your timesheet.
Okay, thanks.
One more? That was quick. Lunchtime? Thank you, and especially thank you. There's a couple of you who stayed in here for 2 hours and 8 minutes. That's very impressive. Thank you so much.